The topic of this webinar is trading with different time frames. And in this webinar I will share with you my experience of combining several time frames together, achieving best trading result. It's been said that we have to combine several time frames like daily charts, hourly charts and 4-hour charts and etc. And too often traders do it very mechanically. They draw trend lines on 15-minute chart, they try to find support on the 1-minute chart, and eventually such kind of behavior does not lead to success. In my opinion, trading with different time frames means that you have to understand the underlying forces behind the price action on each time frame. There are too many traders with different perspectives operating in the market. For example, scalper can trade against long-term position trader. Day trader can trade against high-frequency robot. That's why market is a huge pile of liquidity where many market participants are trying to achieve their goals. And we have to understand this complexity and connect different time frames together in our analytical context. This webinar is about that. We will watch charts and real trading setups that has occurred in the market so far. I suggest you to listen to the information and make notes if necessary, and if you have any questions you can ask all of your questions in the end of this webinar below this video. Now we are ready to start. Before we start, let's take a quick look at the disclaimer. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. Risk of trading in financial markets can be substantial, and you will accept full responsibility for any of your trading decisions. Past performance is not a guarantee of future returns. With that, we are ready to start. And the first question is, what is time frame? How can it help us improve our trading results or focus our attention on best trading setups? Well, time frame is just a way to organize the data. It is nothing more than that. I know traders who are using 2-hour charts or even 100-minute charts. So as you see, it is not very important. But there is another definition of time frame. By time frame we can call specific group of traders having specific perspective and specific behavior. For example, there are traders that trade within a day and there are traders that hold their positions for 3 to 6 months. Trading activity within a day can be huge, especially for the Forex market, but the longer term view traders have, the more volumes they bring into the marketplace. And you can guess that logics of traders from higher time frames can be pretty much different from logics of day traders or scalpers or even HFTs. And a very important question that we can ask is, who is in control? Who drives the market right now? Who is dominating the market? If we identify type of control within a day, we can pay attention to correct reference points, or in other words, pick better trade locations and set more adequate targets. By control, we mean situation when market is possibly driven by the specific group of traders. Of course, the suggested list is pretty much approximate. There are much more strategies than this list contains. But for the sake of simplicity, we can accept this model and proceed with that. And the first type of traders are scalpers or HFTs. High-frequency industry has been developing rapidly within a period of last 5 to 10 years, so now they affect the market very much. For example, when you see rapid volatile swing after news announcement, it is possibly a responsibility of HFT or high-frequency trader, high-frequency robot. Normally bank dealers are not speculating on the news releases. It's almost impossible to do that in manual mode. So HFTs are responsible for that in the present moment. The second type of traders are day traders. It is really a big group because daily turnover in particularly Forex market is huge. It is equal to several $1 trillion a day. Of course, not every lot traded within a day is a result of intraday speculation. But when day traders are dominating the market, we can see specific price action. Overall volatility can be quite big during such days, but eventually market is not going anywhere. When short-term traders or swing traders are dominating in the market, we also see specific behavior of the price. We will pay attention to this type of behavior during the webinar. And finally, there are large traders or position traders who also leave traces on the chart. When price is considered to be too high by swing traders, for example, or day traders, it can be perceived as unfairly low by long-term traders. We also need to learn to capture traces of this group from the chart because it is very important. Those guys are ones who are responsible for creating big trends, or at least large market swings. Scalpers and HFTs have the shortest time for holding position among all other traders. They can hold position for a matter of minutes or even seconds and never hold positions overnight. And if they dominate the market, we can see so-called neutral day. It possibly shows that the market was dominated by this group of traders. When markets are closed for holidays and when there is not enough liquidity within a day, no one really wants to trade and accumulate a position, we can see the neutral day. High-frequency robots start to trade against each other or against day traders who are occasionally buying and selling within a day. And eventually, neutral day is building in the market, which has very small volatility and shows no destination by the end of the day. You can guess that not only day can be neutral, but also the trading session. For example, there are no traders involved in the European session, but after the US session starts, Fed speakers come with an announcement and market is immediately driven to whatever direction. You need to learn to identify neutral days early in the day before it is completed, because it will save you a lot of money and energy. Many traders start to increase their trading volume within neutral days because market moves rapidly. It sort of breaks to the upside or to the downside only to get back to the value, get back to the average, and it can be generated numerous times. Market sort of breaks to the downside, you get inside a trade, then you got stopped, market again shows you the breakout, you again get stopped, then market is going to break to the upside or to the downside again, and eventually you see no continuation. And if you trade within such a day using breakout momentum strategy, for example, you can easily generate a drawdown or series of losses. So if you trade within a neutral day, you have to understand that continuations will be very modest, and you have to switch to scalping strategy or even try to fade the price action. Well, I am not a fan of this strategy because profit-loss ratio for a counter-trend trading strategy is not too good, and eventually you never know how far market will go after the false breakout. It may be 5 or 7 pips, or it may be 15 or 20 pips, you never know, so it's very difficult to calculate risk. So personally I would just step aside and wait until market will show me more meaningful action or presence of traders from higher time frames, at least day traders. Well, when you see this day after it is completed, it is very easy to say, well, I don't want to trade in such a market. But the much more difficult task is to identify this day early before it completes. So you want to decide whether you want to trade in such market or not. Well, nobody guarantees that this day will be neutral, okay, because it can be neutral during the European session, but when the US session closes, market can rapidly break to whatever direction. But all we can do in trading is to estimate the odds. We operate the odds or the probabilities. We don't know the future. But still we have several clues that can help us identify a neutral day early in the day before it is too late. Example on this slide shows what is happening during the neutral day. You see that market action is very unstable and we see numerous spikes or shadows on the lower or at the upper side of the candlesticks. So, quick identification of a neutral day will help you benefit solely from keeping your financial and emotional capital out of the game. Possible emotional capital is more important thing here because suggest you are a position trend following trader and you try to scalp a few trades out of the market The market is not going to move anywhere. You place this first trade, you got stopped in this trade, you place the second trade, the third one, the fourth one, and again you get stopped and stopped again. So possibly you will not recognize your opportunity when it happens, and you will simply have to take a rest from the market because you will possibly achieve your daily loss limit. And after that, when you are emotionally exhausted, the market will start to move and you will not participate in this action. It is very frustrating experience. So if you keep yourself out of the game, if you just observe, if you just watch and not lose your emotional capital, it is the best thing you can do in such kind of market. And here is the first clue. Type of the day is greatly influenced by first 2 to 3 hours of European session opening. If nothing happens during this time, or price action is slow or unstable, the day possibly will turn into neutral. Well, it's not a science. If you struggle to make money, possibly there is no big money to follow today. Leave this market and switch to high time frame or more active market. Also, the odds for a neutral day are increasing when the market is not moving anywhere during the Asian session and when this price action during the Asian session is distributed along the closing price of the previous day, like it is shown here. Here you see the market profile with candlestick chart. So market profile shows us the fairest price to do business for the previous day, and the market also leans to this price during the Asian session. And we see that market breaks, and we see no continuation during first 2.5 hours at the beginning of European session. And I want to show you the current trade that is building right away on my account. So you see that I've opened a long I've opened a long trade here on Australian dollar versus American dollar using the breakout of level 0.7667. Well, I treat this market as a trending one, so it has pretty good odds of setting new highs, but I will observe price action, and if nothing happens during possibly 1.5 hour, if nothing happens here in the next 1.5 or 2 hours, I will just close my position because it will not be a good trade anymore. Well, I can show you several examples from the previous price action. For example, let's take the previous day, March 30, 2016. You see that we had Asian session and we had the market coming to the higher border of this small bracket or the small trading range, and eventually market has broken through this trading range and achieved higher levels. After that, responsive activity has turned this market, or had made this market reverse, but eventually you don't see any rotation here. It's just the fast price action, the very good candlestick, the fast price action, and eventually you see the developing price action during the day. So possibly you may decide to set a trailing stop or to take your profits partially, but you already have profits. You don't need to close this position because you have pretty strong action here during the first 1.5 hour. As for current moment, I don't know yet. I will observe, and I will need possibly 1.5 hour again to make sure that this day will not be neutral. Now I want to show you another trade. I have posted it for students of my educational group in my Twitter account. This trade was made on the British pound versus American dollar. I guess it was March 23rd. Well, it was short trade. It was short trade. Now let's see how it worked. We had very tight consolidation during the day, during the Asian session, and we had a small test here that was a false break to the upside, and market has shown us the level that was good to follow. I have marked it with a red line, so I have placed a short momentum trade here But you see what happens. Market had tested it twice, and eventually, after the most active time of European session was left behind, market had generated another test. So it was the third test. Well, this time it hadn't worked because market had rallied to the downside, and I could have earned around 70 pips on this trade. But I closed this position because market was not going anywhere during 2 to 3 hours after my trade was executed. Well, you see, it is an exclusion. Sometimes market has to generate this third and even the fourth test before it goes. It is an exclusion. Well, this market was trending, and as I have said previously, it is better if the market is neutral, if the previous day is neutral or normal. So if we could have seen the range day, and if we could have seen opening in the center of this day, well, possibly it would be wise to close this position if nothing happens during the 2 to 3 hours of European session. But that time market was trending, and the next day opened outside of this day, outside of the range of this day, so possibly it was a good decision to hold this position until the day ends. Well, we don't predict the future, we just manage the odds. This time odds were so that market had come to the time where we have lots of manipulations. It's 1.5 hours before the US session starts. It's the time for manipulations. The typical neutral activity is shown on the next slide. You see here the continuation of the setup that I was showing you on the previous slide. You see that market had rallied to the downside, but eventually it was not going to generate any meaningful activity during the first 2 hours of European session, first 2 active hours of European session. Sellers were struggling to sustain descending trend. And here on the slide you see the completion of this day. Market was trying to break out to the downside, but every time it was absorbed by buyers. Well, it was not enough order flow or not enough pressure to sustain a descending trend here. That's why it was reasonable or wise to stay away from this type of market. Now let's talk about day traders. How to identify that market is dominated by day traders, and how can we capture valuable information from this kind of observation? Well, the day trading activity occurs when price action reverses exactly on previous day's high or previous day's low, or when it reverses on sessional highs or lows. For example, here on this slide you see the example of reversal on a reference point that is sessional high of the previous US session of the previous day. Also, when market reacts exactly on the opening and the closing price, it is possibly a signal that market is dominated by day traders because they automatically react on these reference points. Now on this slide you see the example of how to use it in trading. For example, we have seen the growing day or ascending day, or even 2 ascending days in a context of descending trend. And then you see that market was trying to touch weekly extreme or weekly high 2 times. First time it was Tuesday, and the second time it was Wednesday. It was just a small test. So the first observation is that market was unable to reach previous week's high, and the second observation was that market reversed on mechanical reference, that is previous day's high. It is indication that market is dominated by the day traders during the European session, during the first hours of European session. How can we use this information in real time? First of all, we can build a level, build a rotational center, and place a trade, place a short trade, because we see that possibly weaker handed were operating in the market. They were not trying to even touch the weekly extreme, so there is no strength beyond this ascending price action, so we can place an opposite trade because we know with pretty high probability that market will rally to the downside. It may not even touch the previous lows, but we can take small profit here, at least small profit. Here is the setup. You see that market touches mechanical reference and is not even trying to touch the weekly high. Well, for the very next week, the situation is pretty much the same. Well, market was not going to achieve previous week's highs, and we see the extreme of the week here. After weekend, market had tried to touch the week's high, the previous week's high, early in Monday, but it failed to do that. So again, we can build a level. We can build a rotational center. It is going to be at the point where the volatility was the smallest for the period. Let me build this level. When I analyze 30-minute chart, I can observe points where volatility is the lowest for the period. We see several doji candlesticks or doji bars, like it is shown here. It is level 1.3224. You see that price touches this level, it goes higher. Then Monday starts, and early in the Monday we see that market fails to test this level. It is a sign of weakness. It goes lower to this level and eventually it breaks this level. We see the initiative here on this candlestick. So we can sell here or even sell at the pullback at the next day. And again, we see the level 1.3224. How can we measure our possible target here? Well, just a minute, I will show you how I measure targets in this case. Well, first of all, I measure statistical deviation from the mean, or harmonic deviation. Then I simply use this number to calculate my target. Here it is. Let us call it AB leg, and this is CD leg. They are pretty much similar. Well, as we are working with a trend, the odds of market going at least to the lower extreme are pretty high. Many traders start searching for the reversal here in such cases. They start searching for a long trade. But in fact, it is very easy to capture a short trade here. It is much easier because every trend first turns from bearish to sideways, and only after that it can reverse. So first of all, every trend has to turn from bearish to sideways, and we can capture quick profit at the test, at the swing that lasts here for possibly 2 days, and it generates a test of lower low. Well, when we talk about other time frames or traders from larger time frames, we don't really know who are involved. We don't know the perspective of traders involved. They might hold their position for 1 week, or they want maybe to hold their positions for the period of 3 months. We don't know. All we want to know here is that traders want to hold their positions for the period larger than 1 day. And in this case, market shows us, number one, it is absorption. Then it shows us wave-like action near extremes. And last but not least is inability to close gaps and minor development errors. Let's go through each point in more detailed mode. Let's talk about absorption. What is absorption? Well, when short-term traders struggle to gain control over the market or over the price action, it indicates presence of stronger-handed trader dominating the market. For example, like you see here on this slide, somebody was trying to push the market down, and you see that market is going down from very mechanical references. it goes down from the one single level. So possibly it is not the big seller involved here, because it is an indication of short-term traders involved. They sell at mechanical reference. But eventually market comes to the fourth test. And guess what happens here? Short-term traders are underwater, they experience losses, they feel pain, they want to get rid of their positions, and market generates breakout or a shakeout. So we see the breakout. It might not be very elongated, it might be very short-term, it might be small, but in fact you can capture a trade here, the capture trade with pretty good probability. And setup that I want to show you right now is New Zealand dollar versus American dollar. I want you to pay attention at this situation that I call absorption. We see several attempts to drive the market down or to push the market down from the area of 0.68 or 69. It was several waves of selling action here, but eventually market had come to this extreme point for the fourth time. And see what happens here. Here is extreme. 0.6893 is an extreme point. Market never touches this extreme at the beginning of the day of March 30th. So you see that volatility is pretty small, and market comes here to the upper border of this setup of this small trading range, and you see the pretty rapid break to the upside. Market breaks beyond the extreme, so it is very good probability here to gain a profit going long with the market, because sellers feel pain here. They want to get rid of their position before it's too late, and they get rid of their positions because they have the opportunity to do this, and it means that control is gained by the larger time frame trader, because short-term traders were unable to drive the market down. They were pushing it down, and eventually somebody absorbed this supply, and eventually market rallied higher, consolidated right below the extreme, and eventually we have seen the rapid break to the upside. It is not very big deal, because market has generated possibly around 100 pips. But also note that your stop loss could also have been very tight here. You don't need to place very big stop loss here, and you can easily achieve 3-to-1 profit-loss ratio here. Well, by the way, we have seen the same situation on Australian dollar like on the situation on New Zealand dollar. Well, we don't have numerous tests of extremes here, because Australian dollar was showing us new highs and new lows. But again, we see a couple of tests here. Short sellers are underwater here, and when you see the small trading range right below the extreme, it is a good opportunity to go long with this market, because you have a breakout trade. Market breaks out from a level and goes beyond the extremes where positions are closed, when the auction here is about to finish. Well, what about my trade here? What about my long position here? Well, for now it continues to go higher. I don't know whether it will sustain ascending move, but I will observe this situation for possibly 30 minutes or an hour. If market will go higher, and if it will gain maybe 10 or 15 pips more, I will hold this position, I will protect my position, I will move my stop and let the profit run. If the market will not go, I will just close this position because the day will possibly turn into neutral or a normal one. What about logic context? Well, we can see the same situation in a logic context. Market can be caught short in the hole, like Jim Dalton says, when, for example, we have seen Australian dollar the end of the previous year, the year of 2015, and the beginning of the year of 2016. We have seen the situation when the market was leaning to the higher border of this trading range, and we have also seen 3 weeks of growing delta from COT report. This green line shows that large speculators were bringing more and more long positions, so market was preparing for the break, and we have seen the pretty good rally after that. It is also the indication of short sellers caught in their short positions. They were underwater, and all they want to do in this situation is to get rid of their positions that are not profitable. Alright, with that we are going to finish this webinar. Thank you for your attention. This webinar was prepared by Stanislav Bernhov, it's me, and Exness Company. Feel free to ask any questions below this video and I'll do my best to answer all of your questions. Please be specific to receive a good answer.